Okay, good. Right, the first market we'll start off with is going to be gold. So a few points I want to note here with you. So if we have a look at the overall price structure of gold, just be aware that the breakdown that we've got over the course, so up until this point into mid-May, we had rallied in the region of 21% year to date. Okay, so we'd rallied up 21%. We then, on the back of the minutes of the FOMC in mid-May, where the Federal Reserve, they indicated they could be ready to increase interest rate hikes as soon as the June FOMC statement, if not June, the July FOMC statement. We saw a huge rally on the US dollar, and we then saw a correction on gold here. So we pulled back quite significantly on gold. It pulled back from its highs over 1,000 points. So it's a $100 move for gold, which was quite significant for those holding longer term positions. We saw various funds and money managers come out of their long trade here. However, we then saw at the beginning of June a surprise to the markets, the worst non-farm payrolls in nearly 6 years, which completely changed the sentiment of the Fed. They were no longer in a position to increase interest rates as soon as June. In fact, the chances of them doing that after the non-farm payrolls reduced to 2% chance. We saw very strong inflows. This is where, again, hedge funds, money managers, they scrambled to build back their long positions at this point, and we continue to see good follow through to the FOMC statement, and also with the more recent sentiment within the European referendum, where we've seen sentiment over the last couple of weeks here be more in favor of a potential leave, but the shift has changed over the last few days, but that continued to help this surge. And then we also had a further breakout to the upside last week. We came up to $1,315 per ounce after the Federal Reserve FOMC statement confirmed there was going to be no interest rate change. So that brings you a little bit up to speed with where gold has really moved over the last 6 weeks here. And at this point in time, as of the close on Friday, when we got this pullback on gold, instead of following through immediately on a bull trap like this, which is what you would expect it would break down to the downside, on Friday we saw very strong inflows as well, from ETFs to hedge funds to money managers, bringing it up to the best close here on gold. You can see, although it dipped above 1,300 several times, it didn't close with such a good close on the previous occasions. 12.99 is the best close that it's had all year, so that does bode well, and that was only on Friday last week. So what does that tell us? It tells us right now that the pullback that we're seeing on gold at this point in time, it is likely again to get bought back into. The question is, how far will it pull back if we were to see the UK remain within the European Union, which we would see essentially back to the status quo on the markets here, particularly on gold. So what sort of impact would that have? Well, the move that we got here from the 1,200 levels upwards to the 1,250 zone, that came as a result of the non-farm payrolls. So that huge surge that we saw to the upside. So realistically, we are either, you've got some nice trend channels here at the moment on gold. We could see a shakeout. So we could just see a shakeout here with gold, where if we were to just see some big volumes come into the market, big sell-off, we could see a short-term shakeout. But I suspect here on gold, we're not going to see a shakeout to the degree where it's going to break down, take out its swing low and break below the 1,200s and be the start of a much larger correction. I would suggest that is unlikely at this point in time, but you never know. We're in uncharted waters here, in uncharted waters. However, if we were to see a breakdown to the downside, so if we did get a very significant sell-off which closed below the swing lows here and also below a 200-day moving average, if we got that sort of a move, yes, a bigger correction is likely in the short term. What I'm looking out for here is, if we do get a further shakeout here to the downside, is to see where buyers come back into the market. So if we do see big institutions, hedge funds, if they're buying back into this, they're looking at it as an opportunity to load up at a better price here, because gold has really turned the corner in 2016. It's turned into a bull market from a 4-year bear market. We've seen significant upside. It's up at its peak there, 24% year to date, only 6 months into the year. In fact, it was up over 20%, only 16% it was up in the first 3 months of the year, and the first 5 months of the year it was up over 20%. So far, pullbacks have been treated as buying opportunities. So I'm looking at this in two ways right now in the short term. A pullback to the lower end of the trend channel, giving rise to potential setup at this zone, which could give us a good buying opportunity, but I would wait. I wouldn't want to catch a falling knife if we were to just see gold breaking down. It has got a V-shaped reversal pattern. It's got some strong underlying support, but if it does continue to break down, I would not catch a falling knife. I would wait for it to give us a buying opportunity, a setup. Or if it continues to consolidate around the 1255 zone, the 1260, if we were to see an unprecedented move, and of course the UK come out of the European Union, then that would see gold very likely an explosive move to the upside. I've showed you the correlations. The volatility index would skyrocket, fear in the market would increase. We would therefore see also this strong correlation between Brexit polls showing, if we go with an exit, that it's very supportive for the gold price. That is where we're very likely to explode with gold, and gold would then follow through, break initially above the weekly or the daily highs over the last couple of days. We would breach above the 1280 zone, and then we would be looking for a run up back towards the 1315 zone. And beyond that, you'd see buy orders, of course, get filled, and you might see a lot of buying continuing overnight as traders continue to add to this trade. 1350 being the next major overhead resistance, and on the larger sort of time frames here, you've got the 1380 to 1400 zone, which would be targeted. That would be a big ask to achieve that within a couple of days, but over the next few weeks, if we were to see the UK come out of the European Union, that could be the potential upside target there. So that's really what we're looking at on gold at the moment. So I perceive this right now as downside. We could get a volatile shakeout on the UK staying within the European Union. So we might see some more shakeout, just a shakeout of speculator positions here, but then those positions could get bought back. Any sell-offs could get bought back into in these major buy zones, which I would suggest is between 1200 to 1250. That is, or 1260 actually, where we're sitting at the moment. On the flip side of that, if we see gold maintain around this current level of support right now, you could argue there is also an additional trend channel here. We could just draw that in at the moment, where we're seeing just gold continue to move between these channels. If we do see this level supported at the moment, we could just see a rotation back up beyond the 1280 zone, breaking out and following through to the upside and continue to rally above the 1315 level. So ultimately, that's what we're looking at on gold at the moment. If there's any questions on that, do feel free to post those. If we move over